Okay, income to need ratio. I think we covered this last week. And basically, this means that if you have an income to need ratio of 1, that means you have enough income to cover all your expenses. And if your income to need ratio is 1, nobody will lend you money, except a fool like me. Sometimes I lend my friends or family money. Usually they pay me back. Okay, but nobody else will lend you money because you don't have enough money to assume an additional charge. Okay. If your income to need ratio is above 1, somebody might consider lending you money, but it'll be kind of hard. If you have an income to need ratio of, let's say, 2, then you might qualify for a loan, right? Or 3 or 4. The bigger the number, the better, right? So let's do an example. Let's say that your income is, you have the average Social Security payment in California, which is $17.45 a month, and you're spending $17.45 a month. You're spending everything, of course. So you have income ratio 1, nobody will lend you money. Car loan, house loan, nothing. You have to ask your family and friends if they lend you money, and they might not want to either. Okay, but let's say that your your expenses are still $17.45 a month, but no, let me go back. Let's say that you're making $2,000 a month, and you're spending $17.45 a month. So now your income to ratio is a little bit over 1. Somebody might lend you money, but I don't think so, because the margin is too narrow. Okay. But let's say you're making $3,000 a month, okay, and you're spending $17.45 a month. So now your income to ratio is better. So at this point, I think people would lend money because there's enough margin for you to service an additional loan. Okay, but let's say you're making $4,000 a month, and you're spending $17.45 a month. Now your income to need ratio is over 2. There are people who lend you money like that. That's how it works. So you kind of want to build up this ratio as much as you can, because when you apply for like a car loan or a home loan, at least when I was the financial analyst or loan analyst many years ago for the Los Angeles Minority Business Development Center, I was one of them. And in those days, everything was based on paper, you know. Well, even today, but everything today now a lot of it's internet and paper. But those days were these folders with divisions. So they're not like regular folders, but they're kind of fancy folders with divisions. And we'd get these applicants, we put them in folders, and then we would do this kind of analysis, like what's their income to need ratio, right? And then, because they were mostly small business people, little businesses, and then we'd rank them, you know. We give them a number. Mine is, you know, below 1, 1, 1.5, 2, 2.5, 3, like that. And we start with the biggest number, like a 5, right? Okay, we lend them money, and then a 4, then 3, right? 2s. And then when we got to 2s, we were like, we better stop here, okay? Because anybody below a 2 may not be able to pay back the loan. So we would send them a thank you letter, you know, thank you for applying. You know, at the moment we don't have enough funds to cover your application. Try again next year. But the truth of the matter was that they didn't qualify because they didn't have an income to need ratio sufficient to service that loan. Okay, so think about that. Of course, if let's say you're spending $3,000 a month, oops, let's say your income is $17.45 a month, right? Your average Social Security payment in California, and you're spending $3,000 a month, which some people do. Now your income to need ratio is below 1. Forget it. You're on the way on your way to bankruptcy. Nobody will lend you money. Nobody. Only a fool. Okay, next slide.